So today, what we're here to talk about Trump's little hands and orange face. Now, we're here to talk about the new bill that he came up with. There's a lot of things that are related to taxes that actually can affect us in whether we're able to buy more real estate or not, how to save more money, and then other areas that it could change us. So that's why I wanted to bring Tony to come and talk to us a little bit more about it because this is a pretty big bill. There's a lot of things that are included in here. So. Without further ado, I'm gonna turn the table over to my buddy Tony Hoon. Take it over, bud.
Cool. Thanks, Andy. Appreciate it. Well, welcome everyone. Thanks for spending the evening with me here. I know it's a little bit later, but it's a good time for all of us. I think today's topic is the one big beautiful bill. So the big thing here is there's a crap load of stuff, and we're not going to go through every single one, but I'm just going to pick out the favorites that I think are the best and just dissect all those here. So we're just going to go through them all, kind of just like, rapid fire some of them and maybe double click into some of them also. And then along the way here too, if you got questions, drop in the chat. I got my laptop down here, so have a look down, or that Annie will monitor on there for that side for you. And then also afterwards too, we got the full guide. So yeah, just stay tuned for that, and you can just read everything on that side. So yeah, big thing is, from a tax perspective, we always say, hey, what Ben Franklin always says, if you fail to plan, you plan. If you fail to plan, you're planning to fail. I think that's his quote. Anyways, it's kind of like I always tell people, bro, you're not going to go to the gym and not have a workout plan. You're not going to build a house without a blueprint. So why are you going to file your taxes without a tax plan? So having some tax plan in place is better than none. And then right now is like a great chance for opportunity with the big beautiful bill. It passed on July 4th, so that was his present to us. And the Treasury, though, the IRS is going to release their regulations, hopefully within like 2 months here. So that'd be 10-4. But the interesting thing is that there could be a government shutdown in by 9:30 if they don't settle on something. So that's going to push things back. Also, I would probably brace yourself for a delayed tax season. So there's a lot of changes. That means a lot of forms are going to be delayed, which means a lot of software is going to be delayed. And then the IRS has been kind of wiped away with, good old Elon and Trump. So I'm presuming that tax returns are going to be delayed this year in terms of e-filing, so just kind of brace for that too. But without further ado, I'm just going to hop in, drop in your questions as we go, and then we'll take from there. So I'm going to try the drawing thing. Need a tax write-off, so I also watch TV on this thing. But you want tax write-offs, always think about what you can use for the business. That's kind of fun for personal sometimes, but it's always business use. So the first part that I would say is I would just say the like locking in the old stuff. So in 2018, when Trump was in office, this dude came in and shook stuff up, and that was the Tax Cuts Jobs Act, and a lot of that was going to sunset by the end of 2026. So that's why they're sprinting to get things done. And locking items in was huge from those tax cuts. So it's a reminder that there's some new stuff, but there was a lot of cementing in the good stuff from before. So what are those items that are locked in permanently now that you should be aware of that you may have not been aware of for the last 6, 7 years? If so, I think you're living on a rock. But the first one I would say, and this helps a lot. So anyone that's like, if if you have a business, drop in the chat too. If you own a business, or is everyone W-2? Actually, if you want to do that and help me with the chat, just let me know if you're business owners on top of W-2s or W-2s only. Obviously, everyone's real estate, so we'll talk about that. But that way we can gear towards some things. But the main part is just the rates are going to stay. So it's 12, 10, 12, 22, 24, 32, 35, 37. So the big thing is that these rates are going to actually stay now. Before, they were going to squeeze you more in the middle here. So the 26 and the 28 were going to come back in. And that would just screwed everyone that's, unfortunately, if people are in California, you kind of fall in this by default just to put like food on the table. So it's actually good that these got like refreshed. So the Tax Foundation, they did a study, and it's probably going to save everyone about 4K that was in the middle class here by not going back to old tax rates. So staying between the 10, 12, 22, 24, 32, 35, 37, you're going to save 4K. So that's actually a good thing that came out of tax law changes and something to be reminded of. And the reason why I bring all this up and why you should care is that you want to have a plan in place. Let's see if I can get the good old eraser out here. Yeah, you want to have a plan in place to get down to 24 actually. So if you're in the 32, your real opportunity savings is to get down to the 24, 22, get down to the next break. Cause we're talking about 10% here. We're talking about 8% here. These are big gaps. So like once you're up here, you're kind of just screwed, but don't get me wrong, I mean, you got a lot of money. So it's not the end of the world. Down here is like, oh damn, you probably should, find some side hustle, get harder into more money, create more problems for yourself. So the key part that I want you to take away here and just write this down. And also if you're not writing anything down, I probably recommend it. You're probably not gonna remember a single thing I say. So, write down on your phone, write down on paper, write down, I don't know, wherever you want, but just remember something. Or if you just want really bad entertainment by me, that's totally fine too. So that's kind of like the big first part that you want to remember here from the Tax Cuts Jobs Act. The next part that was great that got locked in that I really liked was the QBI deduction. And then let me go to here. All right, so on the QBI side, the QBI, oh geez, if I remember how it's spelled, QBI deduction here this is the qualified business income tax deduction. So this is 20% if you have anywhere from a sole proprietor to a LLC to an S corp, you get this 20%. So that stayed in, which is really good for all the small business owners out there. Now, the big thing here, though, what most people miss is that you may get this automatically, but if you make too much, I think it's around $250,000, $300,000 where you start to care, is that this phases out. Also, if you're in it's called an SSTB, Specified Service Trades or Businesses, that phases out for that also. So this QBI, there's actually ways to get the max out of it. The way you can get the max out of it, and this is like more advanced, but it's just called the 2 out of 7 strategy. And this 2 out of 7 strategy essentially just means jack up your payroll to pay yourself 2 out of 7 of your net income. So this times your net income is going to get you the most versus if you just took QBI on, oh Jesus, QBI on your wages, your profits alone. So this is a real like amazing strategy. Like you're probably talking like a $30,000 difference if you actually know how to use this. So the big thing is the QBI stayed in place, which was good. And then the other part too is like if you're running a C corp, C corps they finalized at 21% too. So C corps staying in at 21% is actually a pretty big opportunity because obviously C corps, Fortune 500, Trump wants to help those guys, of course. So this doesn't mean, so C corps, most people think like, oh, I gotta be massive. I don't like C corps, double taxation. That's actually true. But you as a small business owner, you can actually take advantage of C corps. So C corps here, I'll give you 2 strategies here. The first strategy is using it as a management company for your real estate. And this is more advanced. Like I see some really crappy CPAs set this up and I'm like, dude, you're way too small. But if you're talking about, if you're going to send PM fees of, greater than 100 grand a year, this could be this is a time to start having conversation with your tax professional. So, because on that, that means you're generating $1 million of income, assuming your classic 10%. So this is good because you can use this management company as a C Corp to block a lot of income. So C Corps, we always tell folks, C Corps block income from going towards you. So if we go here, is that you as the individual. So I'm going to draw my stick figures here. This is your individual side, and then I'm going to put an LLC here. Oh man, LLC, and then corp here. I don't know why. Okay, here we go. And I'm going to just draw, I don't know, a big box or a big home. Yeah, a big box. I can't draw. This is why I'm an accountant, I'm an artist. So an LLC the income passes through to its owners, and you having a PM company for yourself set up as an LLC is not as good because all the income comes back to you. Now, if you have a corp though, this does not exist. Corps, the money stays stuck here. So that's why you want to consider possibly having a corp, because if you have this much rental income coming in, more likely than not, you have a lot of other money coming in. So just one thing to think about is like, maybe this is how I use a C Corp because it's 21% on this side. Now, the second one that you can do here, where the C Corp makes sense for you also, because entity structuring is actually where the money's at. As our good friends at good old Anderson are always good at scaring you into these things here, is number two, um, right here. So you have the management company is if you make, borderline $1 million in your company, in your corp, this is when you want to upgrade from your S corp. So this is another time here where you put all your active income into this because at 1 million, you're at 37%. So you can arbitrage the difference here. And, it's roughly about 16% that you can save, but the inefficiencies start to come up at $1 million. So this is another part where you can get a lot of savings and gains from. So those are just a few things that I liked out of what came out and was new about the new tax laws here with the one big beautiful bill. Now, a couple things that changed in it that were good, that I really enjoyed here was, the first part is going to be the state and local tax deduction. So they call it SALT. It's not table salt. It's like state and local tax. So on the state and local tax here, the big thing was before you were getting 10K, right? Anything past that. So the state and local taxes, what kind of taxes is this? Number one, it's your income taxes. And then number two, let's see, taxes, if I can draw, right? Number two is that it is also your property taxes. So previous tax law said, hey, I'll get you $10,000 as a deduction, as an itemized deduction for you. So this is for your primary home. This is not related to your rental real estate. We'll get into that in just a moment. But this is where, hey, you have $10,000, you get $10,000. But we all know, like anyone, their mom who owns a home in California, like, dude, you pay way over 10,000 bucks unless you have like some super good deal. And then on top of income taxes, if you're making $100,000, you're going to pay 8K in California taxes. So, 8 plus, 12, this is probably like easy a 20 grand, but you're losing out on 10K of that. So that's horrendous because now you don't get that deduction. So the cool thing that happened out of the tax law change, the one big beautiful bill, and this one's pretty cool. And this is why you want to really tax plan. That 10 now went to 40 grand, which is, 4X, which is wild, right? Because if you take 30K and then just pretend your effective tax rate on the Fed side is 25%, you just got 7.5K more in your pocket just because, oh my goodness. Okay, 7.5K. Oh, come on, right? 7.5K back in your pocket now. So that's going to really increase more money back in your pocket. However, there's downfalls to this. So if it ever sounds too good to be true, like anything else in life, it is true. Like there's a catch. So on this is that this is only if you make $500,000 of total adjusted gross income though. So total AGI. Now it starts phasing out once you go up to $600,000 though. So at $600,000, you're going to drop all the way back down to 10,000 and you're going to lose out on some. So once again, tax planning. I think that's going to be my broken record probably for the rest of my life for anyone who knows me. I'm just going to say, do you have a tax plan in place or not? That's probably my mantra here. And the big part is that you want to plan to get down to this 500,000, right? That $500,000 is that sweet spot at 40,000. You can max that out. Now there's a bonus offer though for anyone who owns a business or a multi-member LLC that's generating positive cash flow. So even if you have the state and local taxes, there's actually a tax strategy, and it's called the pass through. I write it out. Pass through. Okay, maybe not. uh, entity tax. Rather learn how to write faster. Entity tax, entity tax. And this is a tax strategy for S Corp owners and multi-member LLC folks. What this is that your company is going to prepay the taxes for you on your S corp or your LLC, and then you get an income tax deduction on the business return. Then you pick up a tax credit on your personal return. So once again, let's just say that you make $500,000 as an S corp, and this is why the tax code is really written for small business owners, right? W-2, we're kind of out of luck. Like there's some stuff we'll show you, but 500K, just say 10% on that. That's 50K that you can have the S corp write off for you. And then 50K, once again, say 25% rate, that's going to save you 12.5K. And you can still use that 40K that we talked about earlier, 40K for your normal other property taxes and your income taxes. So this is a big slept on strategy that a lot of people miss. So you just definitely want to just be aware of it. And then like everything I say tonight, like it's just a lot of stuff. Like I just want to plant all these seeds in your head and just want to get your brain thinking. Like you don't have to pay so much in taxes if you have a tax plan in place. So that was the pass through any tax election with the SALT, and that's like really big in terms of how much that can save you. Now, kind of diving in deeper and what I would say some random stuff. Like these were all the I don't know, lip service that all the campaigns were ran off of. Probably not as applicable, but maybe. But we can just go into those quick. And the first was like no tax on tips. This was campaigned pretty hard. And this was a pretty interesting one for discussion points. So if you're getting paid no tax on tips, I believe the phase out starts at $150,000. So if you make more than $150,000, you can get phased out. The interesting on tips, though, is that in the tax law, it said traditionally, like, oh my goodness, traditional service-based business. So traditional ones, I didn't know, like, no one knows what that means yet. That's why we're waiting on regulations to talk and see what traditional ones are. I think they're talking about like, what do you call it? Like hair services, restaurant services, like traditionally tipped areas. Saw some interesting TikToks about, does like, me being a CPA and saying, hey, instead of you paying my fees, can I just get a tip and it'll be, no tax on tips. I think there was one viral one. There was like this stripper who it was like get like paid in tips, and that may not be something, but no tax on tips. That was one thing that was touted out there. Number two was no tax on overtime, on OT. And then once again, like it's pretty good. I mean, it's not horrendous, but it's going to cap at 150K. So 150K is when it starts phasing down, fully gone at 160 here. So that's where, hey, it's not bad. It gets some relief for those people working overtime. This will be really interesting because it doesn't say on a W-2 where you have overtime, and you don't send pay stubs on your tax return. So I'm curious how they're actually going to enforce this. Like, if you want to take a random tax position, this one could be it. So that's another one on that side. And then the other one that was kind of like lip serviced was for, no tax on Social Security. And this one is actually pretty interesting because none of these were no tax. It was just limited. Like no tax on Social Security. They're still taxing. They're just giving you a bigger exemption though. So, this is probably for, anyone that mom, dad, grandpa, grandma, that's on Social Security. The exemption just goes up. So you could still be taxed on it. So there was these type of provisions that was put in here. This one was just like stupid in my opinion. Not stupid. It was just an ego play. It's actually good. I'll be honest. It's just the name I wasn't a big fan of. Trump accounts on this side. And then also everything that I'm saying here is just like the tax laws. I don't really care that much about politics. I'm just like, hey, whatever's going to save my clients the most amount of money, that's all I care about. But Trump accounts, if you have a kid in 25 through 28, they will give you $1,000 for that. And what this is pretty much a retirement account for your child. The big thing here is that it is all pre-tax. So that means pretty much you can put in 5K each year. You don't have to have earned income though, which was kind of cool. So you can put in, or anyone can put in 5K, and then also your employer can put in 2.5K. So if you have a kid this year, go ask your employer for 2,500 extra bucks for your kid. But yeah, this was just here. These are only going to last till 2028 anyways, and then they're going to be gone. So it's going to be interesting. I just don't think it's that useful. I think I did the math earlier today, and 1K over 18 years at 8% was it was like 4K. So like even if you literally do nothing with it, I mean, I guess it's 4K down the road if you don't touch it. There are penalties if you don't use it for like education or like your business. So I think there's gonna be a lot more around this. But just Trump accounts came out, so that was just kind of like recapping some, things that were really talked about that I don't think were the juice wasn't really worth the squeeze on those per se. So that's kind of those right there. Now, kind of getting into like the juicier stuff here, and getting to like what matters for real estate folks is, the big part, and, it's no secret to anyone. It's just 100% bonus depreciation is now back. So this is massive for, real estate investors. And previously, this was only going to be at 40%. So this is actually night and day. Like this is something you should actually care about. Like you didn't go shopping now for any type of real estate. You still got 4.5 months left in a year to go execute this. But on, bonus depreciation for anyone who doesn't know is, if I set this up, is that normally, when you buy a whole house, this whole thing is depreciated over 27 and a half years, 39 years if it's commercial, right? Now, in general, generally speaking, is that what bonus depreciation, accelerated depreciation is that these get broken into different buckets now. And those buckets are your 5-year property, your 7-year property, and your 15-year property. So this allows you to accelerate depreciation. Why is it being accelerated? Is because instead of taking over 27 and a half years, you can take some property over 5, some over 7, and some over 15. So it speeds it up. So then you light this thing on steroids, and you can take the whole entire 5, whole entire 7, whole entire 15-year property in the first year, though. So with 100% bonus depreciation being back now, that's massive because, let's just say you bought $1 million property. I'm going to assume 20% of that's land. Not a great assumption, but I'm somewhere in the Midwest. I'm not in Hawaii. So then I'm going to take $800,000 of this is my building basis. And now if I took this now at, say, the full, I'm going to just estimate like 20% to be conservative, 160K is now the bonus depreciation that I can take in the first year versus in here, I'm just going to say what 4 times this only been 64K with the old law. So we're literally talking about well over, $100,000 difference just for how the tax laws are written now. So this is like the banger of all of the whole one big beautiful bill. This is the most beautiful thing that came out of it. So this is great way to utilize it. And like, how do you actually utilize this now? So for all the real estate investors in here, one classic question is like, do I, like, do I run a cost egg? Run a cost egg. And the classic funny answer that all accountants always have is it depends, right? It depends because it literally is in your situation. So let's go with 3. I might have a 4th that might pop up in my head, but there's 3 situations of when you want to run a cost segregation and use bonus depreciation, because now you can see that you can take 160K off on your taxes possibly. In order to do that, though, these are the 3 situations. So number one is that, you have, the one that we use for a ton of our clients is the short-term rental loophole, right? And this is essentially where you're running an Airbnb and you're going over a couple of hoops. The short-term rental loophole, the first prong is, one, you have an average stay of 7 days or less, right? So just take your total, let me scroll up here. Your total stays And then from there, you just divide by your total days divided by your total stays. So as long as this number is 7.0 or less, then you meet prong number one. Now, the second prong, and which everyone hates, is material participation. So material participation, there's 7 different prongs. The 3 prongs that most of our clients have is number one, they have 100 hours and no one else works more than them. Number 2, this one's really hard, is 500 hours. And then anyone can work more than you actually. So this one you can actually have a property manager. And then number 3 is you substantially performed all services. So this one is you may not have the hours, so you could just work, I don't know, put in service in November, run the whole playbook for December, and then you could use this one still. So to do this, like why go through all this headache and all this trouble is because this 160K now is now active losses. So active losses can offset active income, which is your W-2 income. So that's why you want to go through all these hurdles, because before this, so all real estate, it's defaulted as passive income. And the only way that you can juice it up is if you have it up from an active side. So that's scenario number one, is the short-term rental loophole. And if you have a W-2, this is probably your best bet. For sure, if you're single, this is your only bet. Number 2, that could work well, and this is the unicorn of why we do what we do, why you invest in real estate, JK, is just real estate professional status. So reps, REP, REPS, real estate professional status. This is generally for a married couple on this side. You have one person who's the real estate person, the other person's the classic software engineer. What else is there? Doctor, any high stable W-2 job. And so this is married folks. And what do you have to do it? It's 750 hours, 50 hours or more in the trades or businesses of real estate. So the trades or businesses of real estate, generally speaking, it's going to be, you're an agent, so you're brokering. Number 2, you are PMing, you're a property management company. Number 3 is going to be, oh, geez, come on, flipper. So you're flipping homes. So that goes into the development and redevelopment of homes. So those are, generally speaking, the clients that we work with anyways that qualify for the first prong. So after that, so as you can tell, the tax code is just a whole bunch of hurdles you have to keep on jumping. So if you're good at tracking hurdles, that could be a good one for you. So the second part is that greater than over 50% of your time has to be dedicated towards this side. So if you work a W-2 job, which is 2,080 hours, that means you have to work 2,081 hours on real estate to qualify. So that's why it's really hard to do it as an individual, because this is 2 full-time jobs. And I love working, but I don't know if I even hit this many hours until probably when I first started my business. Like this is like legit, you don't have a life, which is, some people actually do this. So I'm not saying you can't, but generally speaking, greater than 50% of your time. So 750 hours, over 50% of your time. And then finally, you go back to material participation again. And this is the key part where most people get mixed up on, is that the material participation has to be on the whole activity. And this is like key part. It has to be on the activity that you want to write off. So like the thing is, if you're an agent, you're positive, you're not negative. If you are negative, you probably have some bigger issues on that side, is that you want your write-offs to be the negative activities. What are the negative activities? Those are your long-term rentals, your short-term rentals, your midterm rentals. That could be anything. So as long as it has depreciation that generates a loss. So this is once again the 500 hours, 100 hours, substantially all. There's a special one in here that is not often, but it's reserved for those businesses who own their own building. So you can actually, there's a special prong for this one if you are a business owner that has your own building. But the hard thing is this is a per activity test, which simply means you have to measure it for each one. So how do you get around this? Because it's impossible to do 100 hours on 20 properties, right? That's literally 20, like 2,000 hours. That's legit a full-time job. But also, I don't think you're investing in real estate to work 2,000 hours. You're investing to have some freedom and flexibility back. So how you do this is the grouping election. The grouping election is where the winners are made. And this is essentially saying that, hey, I have, 10 homes here, and I'm probably not going to draw out 10 homes. All right, multiply that by 2.5. Is that I'm going to group all these homes as one activity. And if I group all these homes as one activity, that means I only need to spend 500 hours with all of these here. So the grouping election is your best friend on this side. So you lumping all this in is that using all the bonus depreciation on all your properties will be a massive offset if you can unlock it with either reps, short-term rental, and there is, the third one, the third time situation, like when do I use bonus depreciation, accelerated depreciation, cost segregation? The other time here is this is a unique one, but for you midterm rental folks, so midterm rentals, or you have highly profitable properties, this is when you use it because you want to use, so let's just say you have house number one and then you have house number two, and saying this one's like a cash cow. Like this is your MTR that's pumping, or what I thought when I wanted to get into a pad split. I thought I'd be making bank, but it's not the case. It's never easy. But this thing's making bank. And then this one is like on paper, you can generate a fat loss on here. So what you do is run the cost seg here, and then this will go over here and wipe away that income. So that's why I say if you're highly profitable or you have an MTR that's highly profitable after, all your expenses and depreciation and interest, this is another time to consider it. And then lastly, there is like the mom and pop exception. So if you actively manage, so this is called the mom and pop, or I call it the mom and pop, is that if you make less than, man, my math teacher would be disappointed in me. All right, $150,000. You can take a 25K loss against your 25K loss against your W-2. It starts phasing out after $100,000. So this was actually how I used it when I was in college. Was had this one property, bought it for like 80 G's, and then like I made like nothing out of college, so it was pretty easy to stay underneath 100K. And then from there, I was just that rental property just lost money each year. So I was able to reduce this and get a refund back each year. So that's when you can use cost seg, bonus depreciation to help you on that side. And then also the one thing here is just like if you have, this was crazy. So if you really watch like tax policy, or not, sorry, not policy, but like what the government's agenda is, it ripples into tax policy. So what I mean by that is that, everything's about, hey, we should bring back a lot of manufacturing in the US. So this is actually an opportunity for those business owners who make widgets. So if you make like widgets or, the real life version, I don't know what, you're making like Labubus or something, like you're actually manufacturing something of some sort, you can actually buy a whole entire freaking warehouse and you can write off the whole entire thing. So previously I mentioned 5, 7, 15 year. You can write off all of this, but you can't write off the 39-year property. You have to wait for your 39-year property. With this new provision, it's allowing you to write off the whole goddamn thing. So literally you could go buy a $2 million warehouse, and if you're manufacturing widgets from that side, generally speaking, if I take 2, 1, 1, I think my example, this would have been 320K, using the math up there. Now, instead of taking 320K, if this is qualified for making widgets, you can write off the whole freaking $2 million. And then this is the crazy part is, you get into say SBA financing, right? You only need 10%. So you put 200K out of your pocket for a $2 million write-off. This is why the rich get richer. Like you literally can do the same. You don't have to be at this scale, but you literally have access to do the exact same thing. And it's just like, dude, you literally created $1.8 million of a write-off out of nowhere, right? By using the tax code. So this is why the tax code is so important. It's a double-edged sword. If you don't know what you're doing, you're screwed. You're going to overpay in taxes. But if you do know what you're doing, I mean, look at this. We created $1.8 million out of thin air. So this was like for making widgets. Not that many people are manufacturers, right? I know most of us are like, working W-2, we're still working our businesses on that side. But if you are in a manufacturing capacity, you probably want to talk to the SBA, go find a house, or sorry, not house, but like a factory, and consider this. This could be massive for your taxes on that side. So those are a few of the things that really stood out for me that I thought were pretty applicable. There's like a whole freaking guide. So I think my automation setup, if not, I'm working on the automations. But if you just hit me up on Instagram, the CPA dude, and then just message me in BBB, we'll have like the full entire guide for you. So those were like the big things that I saw out of here that I thought were useful. Let me just scroll through that guide really quick here, and then also see like what else was like notable that I think would be worth bringing up from a topic discussion wise that you should be aware of for you here. So, charity. And then I got a selfish plug here. So, well, unless Annie, you're not with the college anymore, but sponsor Annie's college, for her students with tax write-offs, deductions, donations. So previously, so charity is huge right here. And then if you need someone to donate to, contact Annie. She's got her college that she supports. So now my commercial's over for that. Is that generally speaking, when you donated, sorry to tell you, it probably didn't help you at all, right? Because the reason why is you either take the standard deduction or itemized deduction. And if you don't own a home, you probably don't itemize. If you are married, you still may have not itemized and you may have taken the standard deduction because donations only go on itemized deductions. So like you just literally donated out of the good of your heart. Don't get me wrong, it's an amazing cause, right? Like you're donating for that. It's not like you're really donating for tax purposes. But now there's a way bigger incentive to donate now. So if you're single, it's an above the line deduction. Above the line means your adjusted gross income's here, and then everything below this is called below the line. So above the line is great because it reduces your taxable income one for one versus this is one for your tax rate. So if you're single, you can do $1,000 and you can donate to Annie's college. If you're married, you can do 2K, and it just has to be more than 0.5% of your AGI. So all your cash donations will actually matter now. So if you want to donate, donate there. That was one thing that popped out, was like, okay, finally it makes more sense to donate. And if you're in excess of that, using itemized deductions is still going to be your best bet. So that's one thing that came out that was still pretty good. And then, oh, nice. Oh, damn, 10K. All right, nice. Okay, cool. So that's one thing that came out. I'll also just scroll my checklist cheat sheet here. Oh, this is fun. I'll just talk about it. It's not financially not the smartest thing to do, but your car loan interest is now deductible. Um, so this is once again, they want to incentivize you buying cars. Oh crap! I'm gonna write this down before I forget. This is actually important shit. Um, so I'm gonna come back to this one. So let me go through this one quick. Is car loan interest? You can deduct up to $10,000 in interest, and this starts phasing out at it's either 100 or 150K of income. I can't remember which one it is, but it's only for domestic cars. So don't, us being the subtle Asian real estate group, I don't know if we believe in domestic cars and probably believe in like Hondas and Toyotas more. But the key part is if it's like assembled here though. So if like Eldar, he's my COO, his Honda Ridgeline was actually assembled in the US. So if he would have bought it back then, they would have qualified, and it has to be new, I believe. So I just don't think you really need new cars unless your car's like falling apart. But if you do need the new car, buy new, maybe think about domestic. You can actually write off your interest on that side. So car loans, that could be good. But that reminded me totally of solar. And this is what would have been really bad if I forgot about it. Holy shit. So solar, this is actually really, really important. And blah, 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 solar. Okay, so on solar, there's two things. There's one, the EV tax. Oh my goodness, this board, EV tax credit. And then also there's the panels. So I'm just writing all this down before I forget to talk about it. But I'll go over the EV tax credit first for your car. So this is going away 9/30, like as in 10, it's August 20th here today. So this, you got like a month plus 10 days to buy an EV if you want that tax credit, which is generally around 7.5K. So if you ever thought about buying EV and you want that tax credit now, I would go do it now. Otherwise, you're going to lose out on the 7.5K. Like I said, there's always a catch to everything here. So that catch is there's income limits. So if you're married, you have to make 300K or less. Number two is the car. Depending on the car, there's caps to what the car is. So those caps is, I think it's like 80K for like an SUV and then maybe 50, 55K for a four-wheel thing, sedan. Jesus. Oh yeah, sedan. So this is going away soon here. Which is once again, like we're talking about buying cars. Once again, you don't need a car, but if you really wanted to save the environment, now's your time to step up and give Mother Nature some love, just because I think Trump and Elon, and they might have had some beef. So he gave you just a big FU maybe to like Elon's EV. And now the panels here, this is actually big. And me selfishly speaking for myself, is that if you ever wanted solar panels, right now is probably the time to buy it. So using the panels, there's two things here. Is that I see these like on our clients' tax returns. They're usually in California 40 to 60K for a whole freaking system. So 30% of this is fueled by the government. So we're talking about 12 to 15K off of your panels. So then your true out of pocket is what, 28 to 45K. And this is for your primary home, right? So, and this goes away 12/31. So you gotta get your permits, get your companies all going on this side because solar does not really break even. So I did the math on this before. And depending on how much usage you have, it's like anywhere from 7 to 13 years for you to break even. So you're either gonna live in that home or when you try to flip the home or sell it, you better get some money back out of it. But if you start the clock now, it's gonna be better. But if you don't have the tax credit, this extra 30% tax credit, I didn't run the math, but this is gonna sure as hell go up. I don't know, maybe like put in extra. I mean, that's a lot of money actually. If I ratioed it, that's like 3 times 3. So this could add, what, another 10, 3, at least another 3 years. So now you're looking at a 10 to 16 year break even period. But I don't know, all the realtors that are in this room here, maybe like, I don't people move homes like every 7 years or something like that? But anyways, this is a good time to act on it. And then there's two other things I have to say on this because I actually did the research on it. Is number, like, if you want, this is a great time to put it on your rental properties. So on your rentals, now how do you strategize with this? Have a 50K system, right? Now you take the 30% tax credit. So now you're down to out of pocket 35K. But now here's the kicker and why tax planning rocks is that you can use bonus depreciation and write off those entire panels in the first year versus depreciating them over time. So if you take 35K, and I'm just going to assume you have a 30% effective tax rate, most people do that we work with. So, 3 times 3.5, you're looking at what, 10.5K off of your taxes. So now your system is 35 minus 10.5. Your true out of pocket is 24.5K. It started at 50,000. You just got this system for half off. So actually, I should get into solar sales. Jesus. But this is really good for your rental properties because not only do you get the 30% investment tax credit, you're also going to get the bonus depreciation on it. And then, and then unrelated was if you have parents that are retired, this is this interesting program. So like my neighbor next door, so we live in HOA, and like anytime you want to do any type of crap work around here, you have to get your neighbor sign off. So then my neighbor, he's retired, and then he was going to install the batteries. So those Tesla batteries, he wanted to put those in. So then, in order for that, you have to get the sign off from your neighbor. I'm like, cool, man, what are you doing? Like, what am I signing on? I was like, dude, knock your socks off. And I was like, wait, how much is this costing you? I was just curious. And it was crazy. There's this program, it's some grant plus it's a grant plus the tax credit. And because he's retired and his income is a lot lower and it met like the threshold, he's getting it all for free. I was like, what the hell? So not tax related at all, kind of is what the tax credit, but like between the grant and the tax credit, he got free batteries. And then he also, I learned later, he got a free solar system on his roof. And I was like, holy shit. So I was interested and I was like, wait, can I do this? And then we're like, oh, no, unfortunately, I got bills to pay. So I have to make some money to cover my life, unlike he's paid his dues already. But very interesting from this grant area. And I was like, oh, interesting. So those are a couple of big things on that side for getting more money through. So that came out of this is going away here. So you want to probably take advantage of it while it's still on that side. And then, yeah, let me just look at the quick list here, and then we'll just hop into questions afterwards for anyone on this side. Yeah, we have this whole list, so you just hit me up and was pop it over to you here. So I know that I just rambled on for almost an hour. I'm not sure if I just bored everyone to death, but at least you can go to bed early. Let's see here, blah, 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 blah. Yeah, I think those are the main things that I care about. The rest is like, there's all the other stuff that not tax related, however you feel. There's Medicaid cuts, there's food stamp cuts. Don't agree with any of it myself, but I don't know, there's this other stuff that's non-tax related that I didn't care about to talk about. But some people are like, why didn't you talk about these? I'm like, because I don't care, dude. Like, I just don't agree with it, cutting those type of programs. So yeah, we'll just take some questions. If anyone's got questions on that side, we can hop into those. And then, yeah, thanks for spending the evening with me here. It's always fun just to chop it up and shoot the breeze here with everyone. All right, let's see. Let me go check out if there's anything in the question area and then go through those. All right, cool. All right. All right. Annie and Maggie. Oh, what's up, Maggie? All right. So do any of these new tax savings have a time phased out policy as for acceleration going back? Yeah. So depreciation is not going to phase back down like it did before. So it's permanent, which is amazing. But there's other ones that, no tax on tips, overtime, Social Security, those would phase out eventually. Obviously, the EV ones that we just talked about, those phase out. Car interest will phase out. So there's some permanent ones, like the tax rates is good, the QBI is good. Oh, this one sucks. So the pass-through any tax that I talked about, not the pass-through any tax, the SALT cap at that 40K, that's going to go away here too. We once again, it's high earners that this goes for. And the speculation is always like the rich are always going to have policies that want to favor the rich. And then why possibly the next term is just going to be, Republican again, because those are the guys who fought for these, which is New York, New Jersey, California. Like they want these type of incentives. But yeah, so those are going to go away. So some of these do go away. Some of them stay permanent on that side. Um, let's see here. All right, Maggie, we got EV tax credit, no income limit for leases. Car manufacturers can pass tax credits in lease contract. True. Yeah, that's correct. Depending on which manufacturer or which company that you use, you can do that there. I'll just bring up my laptop here. So yeah, that's definitely there. Just see who you're going to finance that through, and just because sometimes the other part, I've seen it where you buy the car, and once you buy the car, they just give you the credit then right there. You don't have to claim it on your taxes. And then, or do you just get it back later? You claim it on your taxes. They'll front it to you. So yeah, EV cars, get it. I drive a Tesla, so save the environment a little bit. Let's see, Michael, what's up, man? If concerned about auditing for solar panels, which you need final sign off from utility company, generally once it's like live, you should be good. So happens on like when we file taxes for our solar tax credit, you just put in how much it is times that number by 30% and just wait for it to blow back up. But they usually don't blow back up. It's literally black and white. You have the purchase agreement, you have the go live date, you should be good to go. So there was one with really random. The IRS actually wanted the documentation. Someone hit us up. I don't think they became our clients. I don't know where it went. They're like, I submitted this once. I was like, well, submit like a memo plus. your purchase agreement, and then I never heard back from that person. So hopefully it got cleared up for them so they didn't lose out on that credit. And then Becca, thanks for joining here. Can you explain the QBI and taking QBI with and without safe harbor? If self-managing a property is that a sole proprietor, no LLC. All right, so explain the QBI. So the QBI with and without safe harbor. So QBI, there's so the main thing on QBI, and for most real estate investors, the QBI just goes to losses anyways, because it's 20% of your net income. But if your net income is always negative, you don't have a QBI per se. So where that 2 out of 7 rule comes from is when you start to have specified trades, services, trades, or businesses that are making, I think it's I want to say it's like somewhere around 300K or more. That's when we start to look at it, is that you can use this on payroll and wages, or you take 20% of the net income, and then you can take the higher of. So you have to really do the math between the two and see which one's going to help you out more. So that's why the devil's always in the details. But generally speaking, for real estate investors, though, for your actual rentals, it's always like negative. So QBI is not as effective. It's more so for sole proprietors, S corps, and LLCs. Cool, cool. Oh my! Oh, you seen the you seen the plate? Nice. Yeah, that plate was interesting. It took me like 8 months to get it. Like I submitted it, and I was like, dude, am I ever getting this thing? And then one day it finally showed up, and I was like, oh, sweet. And it's there. We got it. So yeah, that's me for sure on that side. But cool. Yeah, if anyone has any other questions, feel free to drop them in. If not, no, it's been definitely a fun session on this side. Yeah, there's that full. Can I share a screen on this thing? Let me see here. Share. I share screen here. Share. And is it this one? This one? One big beautiful bill. Oh, is it this one right here? Share. Yeah, so this is the whole thing I was kind of like, well, I memorized, but kind of reading off of too. So we just kind of have this like big beautiful bill. All the updates as of 7/15/25. It passed on 7/4, so we didn't really take a big dive deep for a week. But yeah, we have all this. If you want it, just hit me up on Instagram and then just message me BBB there. And I think my automation should be set up. So yeah, hit that up on that side. And then, oh yeah, gold. It's like a green, it's a green yellow, depending on when what the light hits it at. So it's one of those color changing reps that I got on that side. Um, but cool. I think that's everything for the evening. So yeah, I think kind of just reiterate those couple of like things from earlier. Oh, Andy's back here. I was just gonna replug the events that are coming up for you, but you got this way better than I do. I just show up to the events. I actually don't know what's ever going on. Annie plans them all. She just tells me where I need to be.
Yes, and you still have to pick me up on the next week, right? We're gonna hang
Oh,
out on
oh
Thursday.
yeah.
Don't forget.
Oh yeah, yeah. I forgot about that. Yeah.
If I'm skipping out of work to go hang out with you, you better not forget to get me.
Oh yeah, yeah. Good ups, good ups. Yeah. Uh-huh.
Cool. And does this Michael person, if he saw you at Costco, does that mean we have a neighbor nearby now? So is it our Costco, the Richmond one?
Oh yeah. Oh
Could
yeah.
be.
You know me. I don't venture out of my area.
Oh, then that means we found someone that's in our neighborhood. Woo! I thought we were
All
the
right.
only two over here, so.
Oh yeah. There we go.
Awesome. So, thank you guys for coming out tonight. I know this is a little bit on the last minute one. Oh, Berkeley. I work at Berkeley City College. All right, neighbors. Now we can all go hang out. Yay. Yeah, but yeah, thanks for everyone coming out so last minute for this because I was like just kind of making an excuse to get Tony to come out and hang out with us with this new bill because there were just so many changes and it was just hard to understand unless you really read into it and know how to apply it to your own taxes. So super appreciate Tony doing an extra session for us this month. So a couple of quick updates for those who are just coming in. We have, if you're in the Bay Area on August 30th, we're going to have a meetup in San Jose. We're doing Kamayan dinner. So everyone just bring a dish that's dry, not fried, but dried so that we can, and that goes well with rice because you will be eating with your hands. And we'll have it at our friend's house in San Jose. And then we are doing a conference on September 12th in Las Vegas. And so including the the networking and then the city tour. It'll be from September 11th to the 13th. Those are some of the optional stuff if you can make it. So let us know. We'd love to have you guys come out. At the moment, we have two scholarship tickets that were donated to us. So if you are female, you're in real estate, you want to get onto the next level, and you might not be able to afford the ticket or some for some reason or anything. We are raffling out two for those who need it. So just hit us up. I'll give you more information on that. And then as for our next session, we will go back to our regular schedule for the tax workshops. The next one is on September 3rd, so in about 2 weeks. Usually we have alternate every other month, especially, but this one is a special session. So the next one is on September 3rd. It's going to be on small business hacks. So if you are probably like a W-2 person, you might have a hobby or something, and you really want to think of a way to get more write-offs, do what I did. Make up some silly thing called subtle Asian real estate. And then now, whenever you hang out with your friends, every single thing is tax write-off, including my cell phone, including all the dinners that I have, and computers and laptops and whatever I want. So go do that. It's really awesome. All right. So thank you again, Tony. How do people want to if they need to reach out to you? What's the best way to catch you?
Best way is probably Instagram, the CPA dude, website too, the CPA dude, and then we want book called team, go.cpadude.com. So everything's the CPA dude, but yeah, I think Instagram is the easiest. We got someone managing that, so that's a lot easier. And
Oh,
then
are you saying if they're making appointments, they can even do that through the Instagram thing?
well, we can just chat. That we
Web-
have like a salesperson in the chat now, so that helps. So yeah, if you want to contact, that's the first line of defense, and then you just go.thecpadude.com. That's like a direct booking link to one of our tax strategists that can help you out.
And I heard your team has grown a lot since we've met. Like when I met you about 4 or 5 years ago, you were uno dude, one dude. So how's your team like these days?
We just hired three last Monday, and I just shot out an offer today. So maybe 32 soon, hopefully. So
Holy crap. Wait, dude, 32?
yeah, it's grown a bit, but yeah, it's just great support along the whole way. So yeah, it's crazy to see. Yeah, that's why I told you earlier in the call. I'm like, dude, I don't even feel like a CPA anymore. I'm just like HR.
Wait, so I'm like legit OG client then, like
Oh, yeah.
first gen client. Aha, shit, that's kind of
Legacy. Yeah.
cool. Wait, out of curiosity, how many returns do you do each year, or at least this year? How many
This
do you have?
year, I think we're at 1,050, 1,051, one of the two. Yeah, somewhere in that range. Yeah. So yeah, helping a ton of folks. But then you got like some people are like one person that's got like 10 LLCs. I'm like, oh, okay. So that's
Oh,
like
so that's like Jenny
uh,
in here with
uh,
like 5 or 6.
yeah. So
Oh,
no, it's been a journey and it's always fun and it's always just like, hey, just like yeah, taxes, they can be useful if you know how to use them.
right. And it's kind of fun that we were able to grow with you in terms of our businesses and all the side hustles that we did
Oh,
in property. So that's kind of awesome. Thanks, friend.
yeah. Yes. No, this is fun. And then, yeah, a couple weeks coming back with the small business ones and really get those good tips out there again too.
That's right. So again, if you guys have questions, please go hit us up on at the CPA Dude. I have recorded this session because I know that there's a ton of information that we've gone through and you might not have catch it all. So we will be cleaning up the video and then sending it out to all of those who've registered. And dude, go check out if you have the 3 dots on your YouTube and look at the transcripts and run it through ChatGPT to get the TDLIs. It's kind of a fast way to get through a lot of stuff and to look up things. So that's your tip of the day. But without further ado, thank you everyone for tonight and hope you guys have a wonderful evening and we'll catch you next month. Take care. Bye bye.